Today we're looking at an analysis titled Apple Forecast 2026, Why the 4 Trillion Giant is Still Growing, which maps out a path for Apple stock to hit $350.
Right, and it's built on 3 key pillars: the iPhone 17 supercycle, services growth, and of course, AI monetization. It's a very bullish case.
A very bullish case, and the catalysts they identify are sharp. But, to elevate the robustness of this analysis, the major risk factors need to be integrated directly into the discussion of the growth drivers.
Yeah, they can't just appear as isolated notes at the end.
Exactly. I noticed that too. You get these powerful bullish points, the supercycle, the amazing margins in services, but then the big risks are sort of treated like an appendix.
Right. Things like the historically high 37x PE ratio, the recent departure of the head of AI, and all the antitrust scrutiny.
In both the US and the EU, they're just listed, almost separate from the core narrative.
And that separation, well, it really weakens the credibility of the argument. It has to show how these threats actively complicate that $350 price target.
It feels like the analysis is dismissing them by separating them.
It does. So the actionable suggestion here is that the analysis has to grapple with how these risks directly erode that projected momentum. It needs to show the interplay between the risks and the forecast data.
So you're not just presenting a forecast, you're presenting a stress-tested defense of it.
Precisely. That's the move that makes it robust.
Okay, that makes a lot of sense. So let's take a concrete example. The services growth is obviously critical here.
It's the golden goose for the stock's re-rating, for sure.
The report notes 15% year-over-year growth, almost $29 billion a quarter. So if that regulatory risk is real, how do we integrate that specific threat into the actual numbers?
You have to make the risk quantitative. That's the key. So when you're discussing that high-margin services growth, dedicate a section to modeling it.
Modeling the risk.
Yeah. Model how EU or US antitrust regulation targeting the App Store could immediately shave, say, a few percentage points off that growth rate.
So you could build a scenario where maybe mandated changes to payment systems cut the effective services margin by 100 basis points or something.
Exactly. That gives you an immediate, tangible vulnerability that the analysis has to account for.
But isn't that inherently speculative? I mean, modeling regulatory outcomes. Where do you draw the line so you don't just dilute the core bullish message with doomsday scenarios?
Well, the line is drawn by addressing known, active regulatory threats, not purely hypothetical ones.
Okay.
The point isn't to say the growth will stop. It's to show why the forecast is resilient even if some of these risks materialize.
Right, it shows you've thought it through.
Think about the unit forecast. The report is calling for 247 million units for the iPhone 17 supercycle.
A massive number.
And we know that number is almost entirely based on Apple Intelligence driving upgrades. So you have to directly challenge that.
How?
Ask how the recent departure of their head of AI strategy might impact the timeline or the success of those crucial features.
So if the AI rollout gets delayed by 6 months because of a leadership vacuum?
Then that 247 million unit forecast suddenly looks very vulnerable. See? You're linking a specific leadership risk directly to the unit forecast.
I see. It turns what were basically passive footnotes into active, mitigating factors. It proves the analysis has done its due diligence.
And it strengthens the whole structure. It forces you to acknowledge that the $350 target is achieved despite these challenges, not in a vacuum.
Right. Not in a perfect world.
Precisely. And that leads us really to the next central piece of the puzzle here, the valuation itself.
The 37x multiple.
Yes. The material leans very heavily on this idea that the stock can sustain this historically high PE because Apple is becoming a high-margin consumer utility.
That's the absolute hinge point of the entire report.
It is. But I think the core argument for maintaining that 37 by PE ratio, hinged as it is on this transition, requires a lot more empirical defense against traditional hardware valuation metrics.
Yeah, this is where the argument stumbles a bit for me. The report asserts that the services segment's better margins are why the stock can sustain a 37 PE.
But it doesn't bridge the gap.
No. It just states the margin difference. For a company historically built on cyclical hardware sales, 37 times earnings is just staggering. It doesn't justify it against its own history.
Absolutely. So the key actionable step here is to provide comparative financial modeling, or benchmarks, something to actually solidify that consumer utility claim.
You have to prove empirically that the market should treat this company like a subscription-heavy business, not a tech manufacturer.
Yes. If the analysis is claiming a structural shift, then the numbers have to back up that structural comparison.
So we're essentially saying, don't just state that services margins are high. Quantify how high they need to be or how fast they need to grow to justify that valuation gap.
Exactly. Let's just use the numbers that are already in the report.
Okay.
It cites services revenue at nearly $29 billion a quarter, growing at 15% year over year. So calculate the required services growth rate needed to maintain that 37x PE if hardware revenue growth slows down significantly after this 2025 supercycle.
Ah, I see. That creates a clear quantitative hurdle. So if hardware growth, say, falls to 3% post-supercycle,
Services might need to accelerate to 20 or even 25% just to hold that multiple.
wow, that's a huge lift. And that forces the AI and supercycle argument to directly support the valuation argument. It connects them.
It connects the dots. And building on that, the other powerful tool is benchmarking.
Right.
You could compare Apple's current valuation metrics, EV to sales, PE, to established high-margin consumer utilities.
Or high-growth software subscription companies.
Without naming specific competitors, just the sector averages.
Exactly. By showing it aligns with that sector rather than just its old hardware peers, you empirically support the 37x multiple. And that makes the conclusion that a $4 trillion valuation might look cheap feel much more earned.
I appreciate that push for mathematical rigor. It makes the whole piece far more credible, especially for investors who are, rightly skeptical about high multiples in tech right now. Well, it addresses the single biggest source of natural skepticism in the market. Now, let's pivot back to the engine of that revenue forecast.
The supercycle.
The supercycle. The report makes this incredibly aggressive claim that Apple Intelligence is driving device obsolescence, forcing users to upgrade.
That word forcing is the reason that 247 million unit forecast even exists.
It is, and that's why the analysis needs to provide a more specific, more nuanced definition of how Apple Intelligence actually drives that obsolescence.
Because if the force isn't real, the unit numbers just crumble.
They crumble. And where the report loses its footing is that this claim lacks specificity. It makes that huge forecast feel vulnerable because the degree of force is totally undefined.
Right. If the average user can run most of the new AI features on their current 2-year-old phone, the upgrade cycle slows way down.
That's the tension. So the suggestion is to move beyond marketing terms and identify the specific functional thresholds of Apple Intelligence that are actually impossible on older hardware.
You need to clearly differentiate between features that are just, optimized for the iPhone 17 versus those that are completely inaccessible.
Exactly. Inaccessible due to silicon limitations. We need to define the technical necessity that validates the word forcing.
And given the deep technical expertise assumed in this report, this really feels like a missed opportunity to leverage that knowledge.
It is.
So what are the most compelling technical constraints that would actually define this forced obsolescence and support that forecast?
You have to pull from the architectural reality of modern AI. You need to specify which advanced, computationally intense AI features are exclusive to the iPhone 16 or 17 and beyond.
So things requiring a minimum neural engine core count, for example?
A minimum neural engine core count, a specific GPU architecture, a certain high RAM threshold. Yes, that defines the force based on physics and hardware limitations, not just a marketing cycle.
And turns a soft prediction into a hard requirement for the user.
It does. So if the new on-device language models or, say, image generation tools require 16 neural engine cores and the iPhone 15 only has 8,
That's the hard obsolescence that drives demand. That makes perfect sense.
exactly. And then you tie that technicality to the sales data. The report mentions that iPhone unit sales in China jumped 22% month over month.
Right.
Use that, project a potential demand curve inflection point, but clarify if that 22% jump is just general momentum or if it can be directly attributed to the market reacting to specific, unique AI features that older phones demonstrably can outrun.
So you connect the technical driver directly to the early sales data, you're validating the whole supercycle thesis from both ends.
That's how you build a hardened argument.
This has been incredibly insightful. It really transforms the approach from just listing catalysts to building a stress-tested case.